Thank you, James, and all your team for organising this. It's a bit like the phoenix rising out of the ashes. You've got a new name, a new logo, but a new mission, and really, really interesting. And it's great to think that in a small way, maybe the City of London can play a big role in realising and unlocking some of the power within the Commonwealth. I'm delighted we've got a panel today, though, to talk about something which, I have to be honest, is very close to my heart. As some of you who know me for a while, I've been involved in the asset management industry for too long, hence lots of grey hairs. And what struck me when running a fund management business was lots and lots of people want different parts of information, but from the same sort of documents. So whether you're a shareholder, whether you're a regulator, whether you're an insurance company, whether you're a member of staff or you're an administrator, and actually how could you take, if you like, the information from those various different parties and give them access to effectively your database, your spreadsheet. When we first started out, literally bits of paper. And believe it or not, according to Calastone, who are one of the world's biggest third-party administrators for funds, 60% of fund managers still use an FAX, fax machines, which some of you in this room have probably never ever seen or know. Well, James, you're far too young. You've probably never used one, have you? Oh, you had a mobile one? I bet you did. Okay, so I'd like my panel to introduce themselves, and it's not going to be too prescriptive. Oh, I did have a joke. Yeah. How do you catch a catfish? Well, it's not a joke, it's a fact. Anyone know? And it's something that lawyers use, allegedly. Bar of soap. True story. True story. Okay, so Duncan, if I can start, if you can introduce yourself.
I don't know how I can follow that joke. Good morning, I'm Duncan Moir. I run the digital asset strategy at Aberdeen.
Hi everyone, I'm Abeetha Pitigala. I am in Goldman Sachs digital asset team here in London. Look after everything related to our tokenization efforts.
Great, and hi everybody, and thanks for the invite, James. So I'm Jingwei from Fidelity Ventures. So we are the VC team that invests on the balance sheet of Fidelity, which is a $5-6 trillion asset managers. We invest in everything from assets, wealth management, capital market, and I lead investment into digital assets.
Brilliant. Okay, so I think the first thing to note is we've got three of the biggest asset managers, not just in the UK, but arguably globally. And they wouldn't be here if they weren't using something called blockchain, or if they weren't interested in something called blockchain, and the sort of transformational benefits it can actually have. But, Jonny, can I start with you first of all?
Sure.
What's the current state that you see of sort of tokenization in general?
Sure. So I think tokenization as an industry has sort of transformed a lot over the last 5-10 years. And it's helpful to sort of contextualize where we are in the cycle. And I think I sort of describe it into 4 distinct stages. So stage 1, starting around 2017, 2018, you have early adopters like Securitize in the US, Tokenising in Europe. So they designed a tokenization engine to digitally represent an asset on chain. And at the time, you have many asset managers, banks with plenty of R&D budgets, and they were doing one-off POCs with these early stage pioneers. For example, Fidelity, we did a trial where we tokenized the sort of share class on chain, and then Clearstream, that's the post-trade platform by Deutsche Börse, they've done the same thing. And that sort of period lasted for 2 years, and I categorize it as the period of sort of experimentation. Then the next one to follow was around 2019, 2020. And at the time, you have banks and asset managers started to vertically integrate the foundational technologies on their sort of business model. You have JP Morgan launched Onyx, a private general purpose blockchain. And then on top, they launched JPM Coin and TCN, tokenized collateral network. And then you have Goldman launched DApp, you have HSBC launched Orion, you have SocGen launched Forge. But then the third cycle started around 2020, and that's when we have the sort of the trust deficit in the wider crypto space, and that coincides with, number 1, high interest rate environment, number 2, a downturn in the equity market, and number 3, fee compression. Now, what that means for the sort of capital market participants is that there's no more R&D budget unless you can demonstrate a way to commercialize on your blockchain project. Well, guess what? You're not going to get sponsorship in-house. And I think what we are in a cycle right now is the fourth cycle. I called it tokenization revival with a big question mark. And we know the like of abrdn, Franklin Templeton, Wisdom Tree launched tokenized money market funds. But beyond that, we haven't seen that many sort of live projects by large financial institutions. So I think it requires a heavy lift from everybody in the room to take it to the next stage. But however, I do believe that we will get there just based on the conversations we have around this industry.
Blimey, that was a short answer. Okay, Duncan, your company's put its money where their mouth is. You've stumped up some cash for a digital exchange here in London, Archax. You've launched a money market fund. Where do you see, I suppose first of all, why did abrdn, do you think, get involved in it and do what it's done? And where do you see that evolving as part of the heavy lifters we were just talking there?
I mean, I suppose our reason is probably similar to a lot of our peers, right? Like for abrdn, the mission is to deliver and create better or more value for our customers, our clients, and we think that blockchain and other types of DLT can help with that. So whether it's operational efficiencies, so removing or reducing the performance drag from back office and middle office costs, faster settlement times, and also offering more investment content to a wider range of investors. There's lots of kind of drivers for getting into this, and depending on the stakeholder, the benefit will be different. But we still have a long way to go as well, right? Like you said, like there's just not enough product on the market yet to make it truly usweeful to our investors.
And are there any obvious barriers that you've seen, having actually done, put your toe in the water? We've got digital exchanges, we've got insurance companies are prepared to underwrite and give insurance to the companies that are doing it. Yeah. We've even got crazy banks who are quite happy to bank people that are involved in the space. Sorry, that's a plug for ClearBank in case you didn't realise that we actually do bank companies that are involved in that digital asset space. Oh, sorry, I can't do the advert. Oh, sorry.
We
told me I shouldn't.
Which is a big deal. By the way.
Duncan.
Yeah. So I don't know. I mean, I think with a lot of the POCs that have happened so far, they've kind of, even the ones that are, some POCs have been one-off trades just to show that the technology works, and others, there are tokenized funds that have been set up that could technically take in client money, but they've kind of been built on islands. They've been in these different pods that are not connected, and I think the big test is really how do we reach the end investor, and no one's really solved for that properly yet, including us. So I think that is one of the challenges is actually getting to the end investor with tokenized funds, tokenized assets. And right now, one of my biggest challenges is Gen AI, to be honest. It's created so much buzz within the industry that it's taking a lot of attention and resource away from developing blockchain solutions. So there is a little bit, there's definitely an intersection between the two, and they will benefit one another. But we need to keep the focus on what is actually going to have the biggest impact and be the lowest hanging fruit, I think, for asset management.
Okay, so the dreaded AI has crept in already, but there you go. Abeetha, your thoughts? You haven't yet launched a tokenized deposit. You've got a fund that's obviously invested in all sorts of, again, infrastructure. But where do you see the current state and perhaps the near-term trends of things that are coming?
Yeah, so I agree with everything that's been said so four I like to basically draw a bigger picture. So markets, so we're obviously in capital markets, Goldman Sachs, and our bread and butter is basically market making and accessing investors via liquidity providers. Market really evolves over the 60s, 70s from paper to electronic trading with the advent of computers. And that took about 15, 20 years to go through. I really believe that we're now at the stage where we're going from electronic to digital. And what that digital really means is really blockchain or DLT, distributed ledger technologies. So what we're doing at Goldman Sachs is really trying to overlay the technology on the businesses that we provide today for our clients. So it's really putting blockchains and DLTs to a pre-trade and post-trade sort of value chain that we have today to make that post-trade a lot more efficient. Why are we doing this? One, reduce the cost, which is basically savings that we can pass on to our clients. Number two, reduce the risk, improve liquidity, improve access to the various market participants, but also create a much more interconnected capital market ecosystem. I think in the previous panel, there was lots of talk about cross-border payments. We see a lot of challenges in cross-border payments today, which the technology can solve, today. And one of the things that we've really focused on is making sure that we build the technology, partner with the right players, both our friendly competitors and the regulators, to make sure that the ecosystem that we're building upon is the one for the future. Something we haven't really talked about just yet is the intersection between public permissionless blockchains, which is essentially what you see in the crypto domain, Bitcoin, Ethereum, but also banks such as us who are heavily regulated, and rightly so. We're really much focused on what I like to call public but permissioned networks. And there's various flavors of those type of networks, and why we're building on permission networks is really one of governance. A lot of talks about DAOs previously that was mentioned. We love the innovation of DAOs, but there's a big question mark when it comes to governance. So when we're dealing with regulated capital markets, governance is a critical theme that the regulators and in these banks has to get right correctly. So in summary, we're keeping a very close eye on what's happening on the crypto domain. We love the innovation, we love the technology, we love the way it's moving and pushing the boundaries. But we're really trying to basically learn from what's happening on the public domain, trying to apply that to capital markets in an efficient, safe, and scalable way.
Okay, and just carrying on that theme for a moment then. So you like the technology. I know you work in the background on a number of different projects, which I'd love you to talk about today, but I know you can't. But are there any particular asset classes? We've seen money market funds. Obviously, money market funds, well, in doing some research on it, we call them money market funds or cash funds. In Europe, they call them prime funds. In America, they're typically cash or, again, money market funds. Globally, that's a $9 trillion asset class. And we've seen, certainly in the States, a huge amount of money flowing into that, about $6.5 trillion coming out of the banks, going into these money market funds. What's the attraction do you think, first of all, from your point of view, of money market funds for some of your perhaps more institutional investors, and what's the benefit of tokenizing these things?
Yeah, good question. So the inflows that we've seen of for money market funds over the last 18 to 24 months has really been driven by the macro environment, the high interest rates regime that's been sort of spearheaded across globally. Money market funds are a very interesting product because if you look at basically how the creation redemption process happens today, it's very cumbersome. There's no direct peer-to-peer investor transfer that you can do on money market funds in secondary trading. There isn't a secondary trading, liquid secondary trading for money market funds today. So what we can do is essentially take a step back, use tokenization as a tool to enable much more streamlined transfer of money market funds between buyers and sellers, investor A and investor B. And that becomes a very interesting proposition, especially during times of high volatility or stressed environment, because liquidity is key. A good example of this is what happened in Q3 2022 with the UK LDI crisis. There was a lot of outflows of money market funds creating redemption given what's been happening in the UK gilts market. If you had a way to basically seamlessly transfer money market fund tokens between buyers and sellers rather than creating redeeming directly with the fund, you essentially streamline the cash redemption process that you can do by using tokens on chain. So that's really why we.
So surely that's treating customers fairly, sort of that old-fashioned thing, you're looking after your customers, and that's a good thing for consumer duty, which comes into force 31st of July.
It's not a good thing only for customers, but it's also a good thing for the markets overall, because it really allows a safe and streamlined way of basically transferring value across market participants in a very scalable, safe process. And that's really what tokenizing enables us to do.
Okay, but Jing, sorry, I know you said there's lots of heavy lifting to be done, but surely if you were in Aberdeen's position, you've tokenized your money market fund. sorry, go back to I'm running a fund management business. I've tokenized my money management fund, and I've got an equity fund, a fixed interest fund, a property fund. How do I defend, and I'm only doing my money market funds, the others doesn't matter, from a regulatory point of view? It seems there's quite a strong regulatory reason why tokenization, whether it be funds, whether it be bonds, whether it be real estate, or whether it be that funny old stuff, Australian OXO, bit of cash. But why wouldn't you let people do that?
It's tough. So there's right now 75 billion locked in fiat collateralized stablecoins. The Tether, the Circle, the MakerDAO, right? And if you look at MakerDAO, it's a $5 billion DAO stablecoin. And then since 2 years ago, they started a process of investing in real-world assets. So they invested in 500 million worth of BlackRock iShares ETF products. And the market went crazy. The market said, hey, the first time we can have real-world asset on chain. But it's very different investing in an ETF versus mutual funds. With the ETF, you don't own the underlying asset. With mutual funds, you do. That means the KYC AML process is very different. When someone invests in Fidelity's money market funds, there's a 70, 80-page AML KYC document. And any firms need to go through. And we would love to onboard Web3 users because there's tons of treasuries locked in crypto firms and stablecoins. But we just can't because of that regulatory threshold is there. So I think that is a significant issue the market needs to face. However, if we were to have the tokenized money market funds on a private ledger, then that's different. That means the existing KYC ML can be sort of automated by a smart contract. But again, to Abeetha's point, you have the issue of interop, right? An investor cannot access a money market fund that's tokenized on a private blockchain because there's so many sort of constraints and difference. And it's important for large firms to have it on private blockchain because we control sensitive information when it comes to us as a firm and investors. So, yeah, so I hope that answers the question. It's tough, it's the short answer.
Duncan, I know you're not going to tell us what next, but what other asset classes would you say would benefit them from tokenization? Give your personal opinion, not corporate as well.
We think everything ultimately should be on chain. I mean, there's some things that I don't think anybody needs right now. Like, I'm not that excited about real estate. I'm not that bothered about tokenized real estate. It's the one everybody uses to explain tokenization of assets, I think, because it's easy to conceptualize. But I actually don't think that any individual here is probably going to say, oh, I want that commercial property over on the West End of London in my portfolio. You know, how do we make that decision? But I think things like we need to look at what does the market not get today that it wants? I would say corporate bonds. Tokenized corporate bonds would be interesting to the individual investor. Like individual bonds, fractionalized. I think clearly different private market investments, but that has its own difficulties. So if we're talking about the democratization of finance and bringing these assets to smaller investors, we still have to deal with with regulation, suitability. Most of the private market investments are for professional investors. So I think one of the panel, I think on the first panel, maybe it was mentioned same risk, same regulatory outcome. That will be interesting to test. If we can create liquidity in private markets, do they have the same risk as a listed equity? And so should the suitability then change? But these are some of the things that kind of we're hearing that people want.
Just to add to that, I would say, completely agree with everything that's been said. Illiquids markets are, I think, strive for tokenization. Why? Because by enabling
private companies, private funds, hedge
bank
funds.
loans, asset-backed securities, the securitization process that goes through the mortgage markets. If you look at that value chain from bringing a retail mortgage to a securitized note that we tranche out and sell it to the street, it's a very lengthy value chain of process that happens. A lot of it is done manually today. A lot of it prone for errors. By creating a much more streamlined way to tokenize that whole process, there's a lot of value that you can add to that market which is predominantly in illiquid markets. Illiquidity basically leads to collateral immobility. For capital markets to really function seamlessly, you got to have one, price transparency, which leads to liquidity, which then leads to collateral mobility. A lot of the securities that we issue and then trade on a regular basis are not all eligible for collateral and margin sort of purposes. For example, money market funds today, especially in the US, are not eligible collateral in certain very box standards products that trades on a high frequency basis. By enabling tokenization, by creating secondary liquidity, you can then apply that security, tokenized security, as collateral mobility. And I think for us, that's a huge opportunity that we want the market to really sort of get around, to coalesce, to really improve and streamline that value chain.
Okay, so from what I'm hearing, it's continuing to be tough at a retail level, finding adoption, trying to get people to maybe shift from only be able to do it once a day with a price from the asset manager as opposed to independent pricing. But at an institutional level, there seems to be, well, certainly if you look at the lady across the street, Bank of England, they seem very keen on wholesale central bank digital currencies. We saw an announcement this week from RNL, Real-Time Liability Network. They're going to do another proof of concept there. We've seen Fidelity. 860 countries are looking to do some form of central bank digital currency. A number of them, though, are reluctant or reticent to go down the sort of retail CBDCs. Would you say tokenization has a lot more to offer in the short term, therefore, for institutions that you're seeing internally, but also some of your sort of competitors in terms of what they're doing? Is that, did you see that yourself?
Well, the sort of only country that have launched CBDC at scale to the retail market is in China. They launched digital yuan to 20 million residents via WeChat airdrop. But that was simply, again, it was an experiment, it was a testing of that. They can sort of control the payment gateway of
Yeah, but I was more interested in the tokenization of other things, not necessarily CBDCs, but it seems to me that the benefits of illiquid market, look, most private clients can't invest in most of these illiquid investments, but if the technology can help bring liquidity, transparency, things like that, then...
Sure, so we have Moonfair in the venture portfolio. So Moonfair is a company in Germany that help lower the barrier to invest in private equity funds. So historically, to invest in a KKR or Carlyle, you need hundreds of thousands, and Moonfair is bringing that down to about 50K. But still, that's for accredited investors. So via tokenization, you can bring it down as little as 1p, but that's still for accredited investors. We need regulation in place to make sure it can be sort of open to the mass market. So again, the technology is there, but then we have a sort of mismatch between what is possible and what is allowed.
I can add to that. So all the banks are looking at tokenizing the assets, but there's always two legs to the transaction. There's an asset leg and there's a cash leg, right? So when you look at the cash leg, you have essentially two-tier monetary system. You have the central bank money, which is wholesale, and then you have retail money, which is obviously retail. Now, why are central banks looking at CBDCs is really because if the asset is tokenized, in order to basically also provide the cash leg side of things, you have to also have a tokenized cash, right? Now, this is really what the blockchain is all about. In order to truly get atomic delivery versus payment, is the technical term for it, you need to have both the cash and the asset token on the same blockchain. So the central banks are looking at the technology, but also asking themselves the right question: do we actually need a new form of money in Europe, in UK, in all of these other sort of jurisdictions that's basically looking at various CBDC trials and experiments? So, for example, the ECB have launched what they call the ECB trials and experiments this year, investigating 3 individual digital money models, one from Banque de France, the other one from Bundesbank, the third one from Bank of Italia. That's really to provide a set of wholesale settlement technology for the asset leg transaction. At the end of that sort of trial period, they're going to basically publish a report to basically determine whether or not do we actually need a central bank money for the T2 target 2 systems here in Europe. So that's really why I think the central banks are looking at that very closely. Okay,
Duncan?
I think I think we'll probably have clearing solutions for the different chains with the cash and the asset. Definitely, some of those are being developed. But also, what we're talking about is like trying to fit this into the existing old kind of structure. That's not the way the crypto world works, and I think that, like, if I sell my emerging market equity fund or whatever, I'd rather receive the Aberdeen money market fund instead of cash, right? I want to earn a higher return. Why don't I just own that instead of having to then transfer into it? So I think we need to kind of maybe take several steps forward, or look several steps forward, and think about how is this going to work? How should this work in the future? And should investors actually just be trading the assets? I mean, you can see that working in a peer-to-peer platform quite easily, and I don't see why we can't fit regulation around that. Permission peer-to-peer platforms is something that we're looking at ourselves. How can we bring DeFi to CeFi, I suppose?
Blimey. Okay. There's a couple of things which I'd like to sort of point out. First of all, and I know we've got, is James Ramsden speaking later on? Yeah. Oh, excellent. Okay. Hopefully he might touch on this. There's a bill passed on Friday last week, basically meaning that authorities can seize assets without any warrants, court permission, or anything like that. And those assets are crypto assets. Potentially a CBDC is classed as a crypto asset. So it presents a huge challenge. Why would you hold a crypto asset or a CBDC as opposed to cash? Because you've got less protection. So I think that's just a little example of how we need to change the sort of narrative and the conversation so that we have some clarity. The other thing, going back to the sort of digital commonwealth, which I think is really important, the city, all of us are involved in it, we're driving for something called delivery versus payment. When I first started in the industry, you could buy BP shares, you didn't have to settle them for up to 10 working days, T+10. It was called trading within the account. Now we've got T+3, T+2, we're trying to get to T+1 in this country, people trying T0. That's for the financial markets. What about, many of you run your own businesses, I know, why can't you get paid for when you deliver a service? And if we could actually have delivery versus payment for smaller companies, for SMEs, that's 95% of all companies. In this country, it's 68% of all people work for an SMP. An SMP? An SME. You can be very careful with that one. Freudian slip almost. So I suppose what I'd like to leave you with is, yes, we're potentially going to get a change of government in the UK and in the USA. And one of the things which economists keep talking about is our poor productivity. Well, again, I'll reach out to those that are running small businesses. You know how much hassle it is of getting paid. But if you actually were paid for when you delivered the service, the product, or the good, in the same way that's what the city's trying to drive, then actually we may improve the velocity of money. Faster money means you're going to get greater taxes, greater economic growth, because a small company won't sit on that £5,000. They're going to invest it, they're going to spend it, and so that sort of multiplier effect goes on. So I think you're absolutely right, Abeetha. You know, the digital money for tokenized assets is absolutely vital, and the two are inextricably linked. And I think, my personal opinion, you're going to see digital payments come out very, very quickly, because some of the work that I know you can't talk about, and some of the work that some of the people in this room are working on, I think we're talking about within 18 months we'll see a lot more. And it's not just the $2.18 trillion in March that stablecoin transactions, that's what they did. It's a big number in 1 month. That's actually more than the turnover of places like the Hong Kong dollar, Swedish krona, things like that. These are big numbers, and so the technology is there, the adoption is coming, and I think we'll see a lot more tokenized assets. But thank you very much for coming, and thank you for listening.